One of the world's largest oil producers is leaving the cartel that has shaped global energy prices for 2 generations. After almost 60 years as a member of OPEC, the United Arab Emirates is walking out the door, effective from the 1st of May. The UAE will no longer be bound by quotas, no longer attend OPEC meetings, and no longer pretend the arrangement still works. Its state-owned oil company ADNOC has $150 billion earmarked for expansion, a production capacity that already runs over 1.4 million barrels per day above its assigned quota, and a stated target of hitting 5 million barrels per day by 2027. And the announcement landed less than 24 hours after OPEC Plus approved a symbolic 206,000 barrel per day production increase that analysts have already dismissed as a rounding error against the supply crunch caused by the Iran war. So today, we look at why the most consequential single departure in OPEC's history is happening right now, what it actually means for oil prices once the Strait of Hormuz reopens, and how the geopolitical map of the Gulf is being redrawn in real time. My name is Nick, and this is Coin Bureau Finance. For those unfamiliar, OPEC, or the Organization of Petroleum Exporting Countries, was founded in 1960 by 5 countries: Iraq, Iran, Kuwait, Saudi Arabia, and Venezuela. Now, the UAE first joined OPEC through Abu Dhabi in 1967, and when the UAE was formed in 1971, it continued that membership as the new state. Now, OPEC functions as an intergovernmental group of oil-producing countries that coordinates petroleum policy and works to influence oil market stability and prices. Now, OPEC Plus refers to a wider group of oil-producing countries, including Bahrain, Mexico, Russia, and others, that cooperates and coordinates policy with OPEC itself. Now, to understand the magnitude of what just happened, we need to start with the announcement itself, because the framing matters as much as the decision. UAE Energy Minister Sohail Mohammed Al-Mazroui described the withdrawal as a sovereign national decision tied to the country's long-term strategic and economic vision, stating the UAE will continue to act as a responsible supplier in a gradual and measured manner. Crucially, he confirmed that the decision was not debated with any other OPEC member, including Saudi Arabia, prior to the announcement. Almost 6 decades of membership ended in a single press release. Now, this is not the first departure from OPEC, however. Qatar walked out in 2019 to focus on its dominant liquid natural gas industry, and Angola followed on the 1st of January 2024 after a bitter dispute over a 1.11 million barrel per day quota it deemed insufficient. But the UAE is different. Qatar was a small oil producer pivoting to gas. Angola's output was already in geological decline. The UAE is the 3rd largest producer in the cartel, with substantial spare capacity already built and waiting to be deployed. So, markets reacted almost immediately, albeit not dramatically. Brent crude, which had rallied earlier in the session on news that President Trump rejected Iran's latest proposal on the Strait, slipped from around $105 a barrel back toward $104 a barrel once the announcement hit the wires. WTI, meanwhile, crossed the $100 mark for the first time since the 10th of April. But the muted price action is misleading. Put simply, the only reason this didn't immediately tank crude prices is that nobody can physically export the additional barrels right now. John Kilduff at Again Capital framed it bluntly. While the move would typically be bearish for oil, the current inability to export through the Strait renders any UAE production increase effectively trapped. Translation: the price impact has been deferred, not cancelled. And this brings us directly to the core driver behind the exit, the maths that simply stopped working. The UAE currently has roughly 4.85 million barrels per day of production capacity, and its OPEC Plus quota sat at approximately 3.41 million barrels per day. And that's a gap of over 1.4 million barrels per day of constrained, idle capacity that Abu Dhabi National Oil Company, or ADNOC, has spent tens of billions of dollars building, drilling, and developing, and yet is forced to leave underground. ADNOC has an active target to reach 5 million barrels per day of production capacity by 2027, supported by a $150 billion capex commitment running through to 2030. And that target sits roughly 1.6 million barrels per day above the pre-exit quota. So even staying flat would mean stranding more than a quarter of the country's productive capacity. Reaching the 2027 number while complying with OPEC's framework was, in commercial terms, an impossibility. And ADNOC has built the infrastructure to back this ambition up. The Habshan-Fujairah pipeline runs around 380 kilometers from the onshore fields to the Gulf of Oman, with a regular capacity of 1.5 million barrels per day and a surge capability of up to 1.8 million. Crucially, that route bypasses the Strait of Hormuz entirely, giving the UAE an export channel that most of the other Gulf neighbors simply do not have. So this is not Angola, whose 2024 exit was followed by a production decline because the underlying geology and capital just weren't there. ADNOC has the reserves, the pipelines, the petrodollars, and the partnerships already in place. But the quota was the only thing standing in the way, and there's also a documented divergence between Abu Dhabi and Riyadh on regional security policy and oil strategy. A UAE diplomatic advisor has publicly stated that Gulf partners failed to provide adequate political and military support during the recent Iranian attacks on UAE infrastructure. Now, we're not making a judgment on either side here. Both positions reflect legitimate sovereign interests, but the divergence exists, and it accelerated a decision that the underlying economics had already made inevitable. Now, before we get into how this reshapes the cartel itself, the geopolitical realignment, and what it means for oil prices in 2026 and beyond, this is exactly the kind of story that we cover in the Coin Bureau Finance Weekly newsletter. It's free and covers everything that matters in global finance, so you don't find out about a 60-year geopolitical realignment from a thumbnail. The link is in the description, or you can scan this QR code on the right of your screen. And now, back to what the UAE's exit actually does to OPEC, because it's not just a matter of the organization losing one member. Analysts estimate the UAE's departure removes approximately 13 to 15% of OPEC's remaining production capacity from the cartel's direct control. But more importantly, it removes one of only two members with meaningful spare capacity. And spare capacity is the entire mechanism through which OPEC exerts market influence. Without it, the cartel cannot calibrate supply to defend prices when demand softens, and it cannot release barrels to cool prices when supply tightens. Saudi Arabia is now the only member with any meaningful buffer left, and Riyadh will have to shoulder the burden of internal compliance and price defense largely alone. And the numbers around OPEC's shrinking footprint are already significant. OPEC Plus's share of global oil output fell to 44% in March, down from 48% in February, according to IEA data. OPEC's share of global crude seaborne exports has dropped from 47% across 2025 to 34.7% in March 2026. The US has effectively become the world's swing producer, with record export volumes filling the gap. Jorge Leon at Rystad Energy summarized it directly. A structurally weaker OPEC with less spare capacity concentrated within the group will find it increasingly difficult to calibrate supply and stabilize prices. And this begs the question, if the UAE has just shown that a major producer can walk away without immediate catastrophe, who's next? Well, the most cited candidate is Iraq. Iraq's OPEC quota currently sits at around 4.27 million barrels per day against a stated capacity ambition of 7 million barrels per day by 2029. The Iraqi economy is approximately 90% dependent on oil revenue, creating intense fiscal pressure to maximize output for reconstruction and salaries. Iraq has been a habitual quota buster for years, and aggregate OPEC Plus compliance was running at just 67% before the current crisis. If the UAE prospers outside the cartel, Iraq will face a model that becomes very difficult to ignore. Many analysts have actually gone further, characterizing this moment as the potential beginning of the end of the OPEC alliance. The cartel is not collapsing today, but the logic that held it together for 6 decades is fragmenting in real time. Meanwhile, this exit has been widely framed across Bloomberg, Reuters, and the Financial Times as a diplomatic win for President Trump, who has spent years criticizing OPEC for what he describes as ripping off the rest of the world. The move signals a strategic realignment of the UAE toward Washington that has been building for some time. The UAE has committed to a $1.4 trillion 10-year investment framework in the United States, covering AI, semiconductors, and energy infrastructure. U.S. Treasury Secretary Scott Bessent has publicly backed an emergency dollar swap line for Abu Dhabi from the Exchange Stabilization Fund, framing it as reinforcing dollar primacy among Gulf allies. And U.S. oil majors are positioned to be direct beneficiaries. ExxonMobil holds a 28% stake in the Upper Zakum field, one of the largest offshore reserves in the world. In May last year, Exxon and ADNOC announced a phased plan to lift Upper Zakum capacity from 1 million barrels per day to 1.5 million, with Exxon CEO Darren Woods indicating the target could be hit as early as 2028, pulled forward from the original target of 2030. And with the UAE no longer constrained by quotas, that ramp can be accelerated yet again. Occidental Petroleum holds a 40% stake in the Shah gas field, the world's largest ultra-sour gas operation, alongside rights to roughly 2.5 million acres across the UAE. Plans were in place to lift Shah field output by more than a quarter to 1.85 billion standard cubic feet per day. Operations were suspended in mid-March following a drone strike on the facility, so there's a near-term repair overhang, but the longer-term expansion logic remains intact. ADNOC's 2.0 fund acquired Traverse Midstream Partners for $2.25 billion in March, securing minority stakes in U.S. natural gas pipelines. So, the UAE is now a strategic energy partner of the United States, and the capital is flowing both ways. Which brings us to the climax of the story. What oil markets actually look like once the conflict premium burns off and the UAE is operating outside the quota system. Rystad Energy projects that once the Hormuz disruptions ease, the UAE could feasibly bring an additional 1 million barrels per day to market, roughly 1% of global demand. And that sounds modest, but in a market that historically moves on inventory swings of a few 100,000 barrels, it's a significant figure. Brent forecast for 2026 reflect the bifurcation cleanly. If Hormuz reopens and the conflict normalizes, the World Bank projects an average of around $86 a barrel. If the conflict drags on, that figure climbs to $115. Goldman Sachs has put its Q4 base case at $90 for Brent, with WTI at $83. OPEC's ability to act as a swing producer and supply stabilizer is structurally weakened, and the post-conflict price floor will reflect that. Professor David Alms at Warwick Business School made the point that the UAE has one of the lowest break-even prices for oil extraction globally. Translation: even if increased production drives prices lower, ADNOC stays profitable. And that's a comparative moat that the rest of OPEC simply doesn't have. So the era of OPEC as the price setter of last resort is ending. The era of cartel discipline through collective quotas is ending. And the era of single Saudi-led architecture managing global supply is ending. What replaces all of this looks closer to the pre-OPEC market of the 1960s, fragmented, volume-driven, competitive, and more volatile in both directions. Saudi Arabia bears the swing producer burden alone now, and that position is not durable. US shale, with its short cycle flexibility, becomes the de facto market maker by default. And Gulf producers begin competing for market share rather than cooperating to defend price. For consumers, the long-term picture, once the war premium clears, is probably lower oil prices than OPEC would have engineered. For investors, it means more volatility, less predictable price floors, and a permanent repricing of geopolitical risk in every single barrel. For the US, it represents one of the most consequential strategic realignments in Gulf energy since the 1970s. So, OPEC is not dead, but the version of OPEC that mattered, the one that could move global prices with a phone call, is on borrowed time. The question now is whether the UAE's exit becomes an isolated departure or the trigger of a broader unwind. Will the new fragmented oil order deliver cheaper, more competitive markets for global consumers? Or will the loss of the cartel's discipline simply mean wilder price swings, sharper inflation shocks, and a less stable global energy system? Let us know your thoughts in the comments down below. And if you want to understand how the broader Gulf energy realignment is reshaping the security map of the entire Middle East, then you can check out our video on that right over here. That's all from me today. Thank you guys very much for watching, and I'll see you again soon. This is Nick, over and out.